Thanks very much for coming today, everybody, and it's great to have you all here. Our keynote speaker at lunch today is Bill Dudley, who's a longtime friend of mine. He's also, I guess I could say, an old friend, but I tried to avoid using that. Bill, as you probably know, was president of the New York Fed. He is now chair of the Bretton Woods Committee, of which I'm a member, and that committee, in case you don't know the work that's being done there, extends explaining economic and other issues to the public. Gets working groups together. Bill chairs an initiative on the future of finance in that committee, along with Carolyn Wilkins. And that work has really helped people understand a lot of policy issues out there. So today, Bill is going to talk about some policy issues around the use of AI, in particular governance around it, and why that matters. So please join me in welcoming Bill Dudley.
If you go back far into the mists of time, Dick was my boss at Morgan Guaranty Trust. Anybody who has an alumni of J.P. Morgan always goes, are you alumni of J.P. Morgan or are you alumni of Morgan Guaranty Trust? And the Morgan Guaranty people feel very strongly that that distinction matters. So what I'm going to do today, I'm going to talk about three things. I'm going to talk a little bit about the international aspects of AI, but I think those are still pretty unformed, so I'm going to be pretty brief there. I'm going to talk about three use cases for AI in finance, because that's really what the Bretton Woods Committee is doing right now. We're doing a series of papers on AI in finance because we thought that there are a lot of specialized issues in finance that don't get enough attention. We published the first two. We probably have 4 or 5 more to go, and we think this is a way of really sort of developing what are the issues for each of the particular use cases, and then ultimately we're going to conclude with, okay, what are we going to do about these issues as we go forward? So let me start with some of the international issues, just very, very briefly. I think, Bretton Woods Committee is all about international cooperation and coordination, and the mantra of the Bretton Woods Committee is that international cooperation and coordination on global public goods issues leads to better outcomes than individual countries going alone. And I think this is also going to turn out to be true for AI. But I think AI is going to be particularly difficult to make a lot of progress on for two reasons. One, the starting point for regulations and the institutional setup in the different regions is quite different. So that makes it hard to sort of grasp sort of common principles into place in the different regions. And two, and this is probably even more important, AI is very imbalanced in terms of who are the haves and who are the have-nots. I mean, AI at this point is really about the United States and China, and then there's sort of everybody else. And so you can imagine that there's going to be a lot of tension between the U.S. and China trying to push into these other countries, and the other countries being resistant to the consequences of that intrusion and pushing back. And so I think it's going to be hard to get the same kind of international cooperation in this area because the initial endowments are going to be so different. Already we're having disputes with Europe about, digital taxes, for example. So I think it's going to be very, very hard to make a lot of progress on that front. So I think international, to be determined, but a really, really tough thing to solve for. Particularly probably vis-a-vis Europe, because Europe is really good at regulating early before they've consulted with other regimes. And that makes it then very difficult to actually coordinate other countries' regimes with the European setup. You actually see that in digital finance space because they've already passed MiCA, which is governing the market rules for crypto assets, running way ahead of everybody else. And now the question is, okay, how are you going to get convergence between everybody else and where Europe stands? So AI in finance. So I think it's going to be really important. But I would distinguish between two aspects of finance. One, the use of AI for internal-facing functions in finance, and AI in use in outward-facing functions. I think in inward-facing functions, this is going to go very fast. You know, AI for use in compliance, AI in use for AML, BSA compliance, risk monitoring, you know, trying to prevent things like the fat finger, you know, aspects where someone put in 5 trillion when they meant 5 billion. And if you have an AI agent monitoring, you know, everything in the organization, that just should never happen. Making sure that claims on collateral are perfected, so people can't, you know that the collateral hasn't been pledged elsewhere. Analysis and research, you already see that happening really, very quickly. When I go talk to people in investment research, the question they ask now is, okay, I understand we're still going to need senior analysts, but how are you going to become a senior analyst if there's no junior analysts? And so this whole question of what's the pathway to becoming a senior analyst, given how fast AI is moving. I think for the outward-facing services that financial industry provides, so it's going to be a lot slower. It's going to be a lot slower because all the risks that the firm is willing to take internally, bias, hallucination, explainability, they're probably not going to be willing to take those same risks to anywhere near the same degree on outward-facing applications. So financial advice. You know, the rules for financial advice in the U.S., if you're not a sophisticated investor, are really high. You have to explain to people what you're doing. You have to explain all the risks. If someone comes to you for a loan and you turn them down, you have to actually explain to them why they were turned down. All this stuff has got a huge amount of regulation embedded in it. And so to use AI in that world, AI can't be just like 99% good. It's got to be 100% good. I don't know how many of you saw the article this last week about Sullivan and Cromwell. Apparently they used AI for preparing a brief for some court filing. And it turned out AI hallucinated, included, I guess, cases that didn't actually really exist. It cited case law that wasn't actually case law. So those kind of episodes are going to just be the cautionary tale that raises the bar for people to use it on outward-facing things. So I'm going to talk about 3 outward-facing things today because I think that's more interesting than the firm just using AI for business purposes. You know, the inward-using stuff is going to be AI used for business purposes, just like everybody. I mean, call centers. Call centers are going to be used by banks, but the call centers are going to be used by a lot of other things. So I'm going to focus on 3 things: financial advice, underwriting, and I would call underwriting mostly credit, but also it extends to insurance kinds of underwriting, and trading going forward. Finally, before I go into that, I just want to say some of my own personal biases on AI. I believe AI really depends on high-quality data. And that's also going to slow down the financial industry in terms of using AI well, because AI is going to work best for a large financial firm if the data is a golden piece of data and that it can move seamlessly across the organization. And right now, most financial institutions can't move data seamlessly across the organization, and they still haven't actually cleaned up all their data, so they actually have that golden copy of the data. So one thing that's going to slow down getting the full benefits out of the big financial institutions is just that the data is not good enough yet, and they don't have the ability to sort of flow the data back, and back to back across the whole organization. Second thing I would say is AI works really, in my mind, works much better in a static environment than in a dynamic environment. And so what do I mean by that? Static is like the laws of physics. We have laws of physics, and those laws of physics presumably don't change. But things that are dynamic are when there's innovations into the world, and if you have a model that's trained on backward-looking information, that model may not be able to incorporate that new innovation. And I think about the last 10 years, I think about the COVID pandemic. So let's imagine we had a model for the financial system trained to perfectly for everything that preceded the COVID pandemic. And all the training was done on basis of history and historical relationships. And then all of a sudden we have the COVID pandemic hit. Now, maybe the COVID pandemic, maybe the models could make some sort of inference about what happened in 1918 during the influenza. But boy, there's not a lot of data between 1918 and 2020 that's relevant for how you think about that. So I think if things are dynamic in terms of the world's changing and changing not gradually but discreetly. So if it changes gradually, the models can sort of catch up. But if it changes discreetly, then I worry that the models will actually be very good. So another example, tariffs. We had a big tariff shock. First big tariff shock since Smoot-Hawley Act back in the 1930s. So that's another example of how would the model deal with a tariff shock. Okay, so let's go to our use cases. First one is financial advice. Right now, there already are models of how machine learning is used in financial advice. We have sort of three levels. The most basic level has been around for a while. That's robo-advisors. That's basically you set up an account with Wealthfront or Betterment. You don't really talk to a person. You just talk to this bot that sort of tells you, given your, you fill out a survey, you tell them what your financial assets are, and it gives you some reasonably informed answers about what someone in your circumstances should do. Second model for financial advice is advisor co-pilots. This is not where the AI is displacing the advisor, but it's basically helping the advisor do their job better by keeping track of correspondence, by keeping track of what's happening to the person's portfolio, by giving suggestions to the advisor about, given that this is the preferences of the advisor, this particular stock or tax strategy might be appropriate for this person's circumstances. So it's basically allowing the advisor to do less maintenance of the account and more, advice and expertise of the account. And the third one, and this is the one that I'm really going to talk about, which is still hasn't happened yet, but it's coming. When there is no human intermediary, you're just talking to the AI agentic bot. And I think that's, going to be very, very different than any of these other things. Because what's different about talking to an AI advisor that's just AI is it's not going to be like normal financial advice where you put in a bunch of inputs and then the advice comes back. It's going to be conversational, continuous, and tailored to the specifics of that particular conversation. So it's going to be quite different than how we do things today. Today we do it sort of, we have a conversation, we do something in response, we wait a while, we have another conversation. So this is something that's going to be driven more by the customer, by how often they want to talk to their AI agent, and then where that AI agent essentially takes that customer. Now, the benefits of using AI advisors in any of these roles is pretty obvious. A lot lower cost to service your customers. So you can probably take that human person and spread them much more broadly, so you can reduce your unit cost of providing services. Presumably also you can increase the quality of the service. And so you can sort of see that this is, you can certainly see the attraction of going in this direction. But there are some pretty significant risks. The first risk is accuracy, hallucinations, innovations. All these things are going to introduce questions of accuracy. The second issue is privacy. If this AI agent's having conversations with a person, they're soaking up all sorts of personal data, and they may be using that personal data in ways that are not necessarily completely appropriate. They may be getting some aspects of personal data. Given that you told me this, this, and this, I decide that you're of this ethnicity, and therefore, because of that ethnicity, I'm going to recommend that trade. Well, that's not really allowed, but the AI agent may not, show you that intermediate link in terms of why that agent reached that conclusion. Privacy, so that's an issue. And then the last one is model convergence and herding, which is something I worry a lot about. So let's imagine that we have the perfect data set. We train all the models on the perfect data set. Well, all the models are going to behave the exact same way. So I do worry that over time, the better models are going to crowd out the less good models, And so you're going to tend to have a convergence. And that, to me, suggests that you're going to potentially have crowded trades. And when there is an innovation, where there is a new data set, everyone's going to want to move simultaneously to the new equilibrium, and that's going to really be quite messy. So I worry about that. Now, the good news in terms of this whole private advisory stuff is that we don't have to invent a whole new set of regulations for AI, because we already have an existing set of regulations for all these things. Communications have to be fair, balanced, not misleading. We have rules for suitability. You know, we don't want to put someone who's, you know, a school teacher, retired school teacher into, large, way out of the money options on the S&P 500. We want there are laws to make sure that people behave consistent with their fiduciary responsibility. There's disclosure requirements, and there's constraints on conflicts of interest. So the good thing is we don't really have to reintroduce a whole set of regulations. All we have to do is ensure that AI in its final form produces output and outcomes that's consistent with this set of rules and regulations. So that's really the challenge. Is sort of how do you take this new thing and make it produce output that's consistent with the existing set of regulations. Consumer finance. So we've had, we're on a journey on consumer finance. I mean, obviously, we have some pretty sophisticated models in terms of credit scoring. And the credit scoring, leads to a lending decision, can lead to changes in, the pricing of the lending decision, the loan to value ratio of the lending decision. But AI adds a lot to the consumer finance decision as well, because AI will be able to add lots of particular information about the borrower that really isn't in the credit scoring model. And the AI will be able to look across multiple models. So it won't be dependent necessarily on one credit scoring model. It can sort of see, you can sort of triangulate and say, well, this model says that this person should be rejected, but these other models are more neutral. And I have this other piece of information over here that shows that this person has an unusual source of income that these other models don't really understand. And I think that source of income is credible. So the decision logic is going to be quite a bit broader and much more complex than what we have today. Now, the benefits of that is you have more information, and you have presumably more information that's germane to the riskiness of the underlying loan. You should have more accurate underwriting. And this should basically allow less type 1 and type 2 error. So you lend to the people, you stop lending to people you shouldn't be lending to, and you start lending to people that you should be lending to. So I think it's generally a good thing. But again, we have risks. First of all, we have the risk in terms of bias. Is the model capturing some sort of ethnicity, age, disability issue? And that's sort of feeding through in terms of the underwriting decision, even though we can't see that really in a transparent fashion. Second, the rules, the laws require you to explain to someone why you've been turned down. So here the explainability isn't just sort of theoretical. You have to actually be able to give a reason why the AI model rejected you. And that might actually be pretty difficult to actually parse if the model is very complex in terms of reaching its decision. And the last thing that I worry about in terms of risk is what I call exploitation. This is not a level playing field with the financial firm controlling this very sophisticated AI agent and the individual talking to the agent. And you can sort of imagine that, well, if the purpose of this whole exercise is just to make sure we underwrite the right people in the right way, no problem. But you can also imagine a situation where the AI model is used to, someone with these characteristics would actually be willing to pay 0.25% more on their mortgage if we ask for it. So let's ask for 0.25% more on their mortgage. And in that case, that's not really fair. The model is exploiting the information asymmetry between the person who's on the receiving end, the customer, and the model. So there's definitely some interesting issues that have to be solved there. Last one I want to talk about is trading. And you know, I obviously see the benefits. You know, you just incorporate so much more information in terms of your trading. I really enjoyed the panel this morning on the you know, the econometric issue. I took econometric theory at Berkeley from some pretty good professors, and I don't know how much of it I remember, but I remember one thing in particular. You're only supposed to run the damn regression once. You start with your prior, you have your variables, you have your reason why you think the variables are appropriate, and then you run the regression once. And if you run it more than once and you fiddle around with the variables and you fiddle around with the data, you're basically not conforming with the assumptions of the econometric model or theory. So I really enjoyed that. So on trading, I think there's so much more information you can train the model on. Patent filings, earnings calls, scraping internet data, satellite photos of how much traffic there is at the mall. So a much broader set of issues. But some of the same issues that came up before come up here again. You're not going to have a very good ability to explain like why the model wants to do X versus Y. Now, maybe if maybe here that's not such a big issue because you sort of own the risk, and maybe you don't understand why the model is doing what the model does. But still, I guess I would at least at some level want to at least have some understanding why the model is pushing me in a particular direction. Herding we already talked about. You can have convergence to the same views, and then instability on when you have an innovation, which I already talked about. So I have a few minutes left, right, Dick? Okay, so I want to shift gear now and talk a little bit about AI and risk, not in a sort of micro financial sense, but also in a macro sense, because that's also getting a lot of attention these days. I don't know how many people saw the report by Citrini. They put out a report a couple of weeks ago, and it was really, it was dystopian. Basically, what they concluded was AI innovation is going to happen really fast. A whole bunch of people are going to be put out of work. Their skills are going to be made obsolete. They're going to be put out of work. They're going to have no income. The AI providers are going to get all the income. They're going to save a lot of their income because they don't have anything to do with it. And there's going to be a shortfall of demand, and we're actually going to be in a depression. I think it was an interesting paper because it's thought-provoking, and I liked the paper in the sense that it looked at the entire system rather than just a little piece. But it had a pretty strong set of assumptions. The biggest assumption was that the savings rate goes up dramatically, because that was really, they didn't really say that in the paper, but that's the reason why you have the depression, because there's a shortfall of demand because you just moved a lot of income from people who would have spent to the AI providers who aren't going to spend. And so the outcome was essentially by construction. So it wasn't really quite as sophisticated as they let on. So at the macro level, I think there's two sort of key issues. The first one is AI going to be mainly labor augmenting or labor replacing? And I think the answer is it's going to be both. And it really sort of depends on what your job is. The second is, of course, the speed of adaptation. Now, it's very scary if it's labor replacing, happens very fast, happens very broadly. That's sort of the Citrini outcome. But my view is a little bit, I come out a little differently. I think it's going to be labor augmenting and labor replacing. But I don't think it's going to happen as fast as people think. Because, number one, all the outward-facing applications have all these risks of bias, explainability, make sure they're conform with existing laws and regulation. But also, too, businesses have to reconfigure themselves to take advantage of AI. They need to clean their data. They need to make sure that the data can move across the organization. And they have to reconfigure how they do business to really capture the benefits of these AI models. If you look at historically, big innovations, big general purpose technologies do not happen very quickly. I mean, the example that people use time immemorial is electric power generation. It took about 30 years from electric power generation, in fact, to when you actually had mass production of cars on the assembly line, really capturing the full benefits of that. Near term, I think the biggest macro issue is really going to be not the speed of innovation, but the investment boom that we have in AI, followed by what I think is almost inevitably going to be an investment bust. I think what you're going to see in the near term is a tremendous race to get to the best model. There's every incentive to get there first because there's huge network effects from these models. If you're fourth or fifth, you're going to lose out. The network effects also mean there's probably going to be 2 models that dominate rather than 4 or 5 or 6. So there's a huge race to spend a lot of money to get over the finish line first. So the winner-take-all aspect, the fact that speed to market really matters, that's what's generating the investment boom that you're seeing today. This year, the 7 biggest hyperscalers, I think their investment spending is projected about $650 billion, up from about $300 to $400 billion last year. I mean, I'm amazed that you can actually invest that much money in this space in that period of time. I think this is more like authorization as opposed to actual spending. I don't think they're actually being able to spend it that fast. So the first issue is you're probably going to end up with a bunch of people that lose out and their capacity is just going to go away. The second issue that I think is really likely to lead to an investment boom and bust is they haven't really solved the question of how they're going to get paid for all this. Most people expect that by the time the dust settles, we're going to have invested something like $6 trillion or more in AI infrastructure and AI training. And if you think about the rapid depreciation rate of these data farms and the chips and all that stuff, you probably need to generate something like $2 trillion of revenue a year to basically get a return on capital to justify that investment. I think that's going to be really difficult to do very quickly. Now, what's going to happen is there's going to be essentially a battle between the AI providers that are going to want to lock people in and then gradually ratchet up the price, and the AI users who are going to want to maintain their optionality so that they can move away from one AI provider to another if the pricing becomes a little bit more difficult. As long as the 7 people have enough money to limp on, for at least for a while, the pricing I don't think can get that good, because there's always going to be someone who's going to want to put their hand up to try to sort of stay in business for as long as possible. So I think the next few years are going to be very, very interesting. Oh, finally on AI, Kevin Warsh is going to be the next Fed chair, apparently now May 15th on schedule. The Justice Department has removed their complaint against Chair Powell today. Kevin is basically saying the AI boom is going to raise productivity and therefore we can lead to dramatically lower short-term interest rates. I don't buy it for a second. He cites Alan Greenspan in the 1990s because of the internet bubble boom. Alan Greenspan famously said internet boom is going to lead to a productivity surge, so we don't have to tighten monetary policy in response to the surge in economic activity. 2 things that the Bassett-Warsh argument ignore. Greenspan did not cut rates because of the internet boom. He generally kept rates steady. Number 2, rates were higher than they are today. Between 1996 and 1999, federal funds rate, low point 4.6%, high point 5.6%. Where are we today? 3.6%. So Alan Greenspan just, he basically believed that there was going to be a productivity boom. Didn't tighten monetary policy because of it, but he basically didn't make monetary policy easy. And lastly, when you typically have a productivity boom, what that typically does is it raises the demand for capital, and we're starting seeing that right now with the investment boom. And when you raise the demand for capital, what does that do to real interest rates? It raises real interest rates. It doesn't push them down. Now, it's possible in the fullness of time that AI could lead to a repurposing of the existing capital stock, and so you don't raise the long-term demand for capital, and so real rates don't go up for any extended period of time. But it's also possible that this innovation could obsolete a lot of the existing capital stock, and therefore you actually have an extended period where you have more demand for investment. But But in the short term, what's going to dominate is really the investment boom that's happening right now. And we know what direction that pushes in. That pushes it towards higher rates, not lower rates. But I guess it was a good argument to make to President Trump.